Chapter 14, all right, what are we going to do in this chapter? In terms of problems, the big problems in this chapter are 73, 76, and 79, okay? And the code sections for this chapter 14 are 1231, 1245, and 1250, okay? There are three major questions in this chapter. What is the amount of the gain? And then is it capital gain or ordinary income? And then what is the capital gains rate? Now, the capital gains rates are basically 0, 15, and 20. And you'll remember those are for long-term capital gains, property held greater than a year. Now, that's specifically what this chapter 14 will focus on. We'll put this back into the context of where we were at the beginning of the course when we first touched on this in just a minute by going back to some old PowerPoint of mine for the beginning of the course. We also should look at, just briefly here, Chapter 13. These are two long, difficult chapters at the end of the 426 Tax 1 class, both about property transactions. Now, what's a property transaction? This formula, right, that we're going to go back to at the beginning of the course, or from the beginning of the course. Amount realized minus adjusted basis equals gain or loss, right? That is a property transaction. I use the example frequently. I go to Temecula and I buy raw land, unimproved land. I pay $500 for it, right? It goes up in value and I sell it for $550. So my amount realized is $550. The basis is basically cost, $500. That gives me a gain of $50. Now that gain is in income, right? If we go back to the formula we started the course with, right? Back way at the beginning of the course, and even when I did these recordings, we did a sample recording where we were back at the beginning of the course. The formula starts out up at the top with gross income. And that gain on a property transaction is in gross income. It's in the income. And then we have this question in chapter 14, at what rate will it be taxed? Okay. All right, so chapter 13, right? You may remember that the problems in that chapter were 45, which dealt exactly with that formula, and then 68, which dealt with basis, right? Both an inherited basis and a gift basis, and then some specialized problems, 74, 84, 88. Those are the big problems in that chapter. More are assigned, but try to work some of these big ones in class. 74 was 1031, 84 was 1033, and 88 was 121. Now the questions for chapter 13, there's three code sections, three questions slightly different from chapter 14. Chapter 13, there's our code sections, 1031, 1033, 121. And the questions are, what's the realized gain or loss, right? What's the recognized, right? Recognized gain or loss, and then what's the basis, right, of the new property? Basis is basically cost. And what we did in chapter 13 was find out that we won't always have to recognize realized gain. 1031 allows a postponement where there's an exchange of properties. Under the new law, the 2017 TCJA, Tax Cuts and Jobs Act, 1031 now is restricted to real estate trades, right? 1033 deals with involuntary conversions. The property's taken involuntarily by a casualty or by the government, and the taxpayer ends up usually with cash. We could have a gain on that, right? The 1033 code section allows a postponement of the recognition of that gain, just like 1031 allows a postponement on a trade or a swap if you meet all the requirements. 121, many of you may be familiar with. We mentioned that way back at the beginning of the course. That's the principal personal residence, right? Principal personal residence exclusion, not merely a postponement, but an exclusion, like a chapter 5 in the textbook exclusion. You sell your house after you own it and use it as your principal personal residence for at least 2 years. It's 2 of the last 5. They do a 5-year look back, but own it and use it as the principal personal residence for at least 2 years. You can exclude the gain, right? Up to $500,000, right, for married filing jointly, and $250,000 for all the other filing statuses. Okay, So these are our property transaction chapters, 13 and 14. Today we'll be focusing on first a lecture on 14, and then time permitting we'll get through some problems on 14. And I said I would go back to the very beginning of the course, right? Okay, so now we're back in the Blackboard course, and I said I'd go back to my PowerPoint from the very beginning of the course, my own PowerPoint. It's in additional resources, right? There it is, Chapter 1 PowerPoint. Okay, and we want to go to the guy holding all the money. Right? There he is. Okay, and we're back to that formula, right? Want realized minus adjusted basis equals gain or loss. I have this in some old PowerPoint of mine for Chapter 1, but it's really Chapter 3, as I said on this slide, right where we start this course. Realization versus recognition. Realization, there is some trigger, a sale or exchange, as we were talking about when I was overviewing chapters 13 and 14. Property is a capital asset, right? Usually, as in tax, we often have to say generally, usually, which means if you sell even your car at a gain, right, that would be generally a capital gain. Same thing with selling your house, right, at a gain, but we have that big exclusion under 121. Long-term capital gain is what qualifies for the special rates, which are basically 0, 15, and 20 right now. Long-term means it's been held greater than a year, okay? Now, Code Section 1221 tells you what is not a capital asset. That's how they define it in the code, but telling you what is not. These are some of the things, these are the big ones in 1221, at least for our purposes here, that are not capital assets. Inventory, right? You're selling property. You may remember this from the beginning of the course. Accounts receivable, creative works. You're the next person who writes Basic Instinct. I used to think that Joe Esterhaus sold that for $1 million, but I think it was $3 million. Way back when. That's an old script already, right? You might think, geez, you're selling either a pile of paper or a computer disk or a USB drive. Looks like but you're really selling something intangible. And creative works, a script, the painting, by the author, by the painter, that is not a capital asset. There's a way to buy and sell government documents, not a capital asset. What does that mean? Well, if it's not a capital asset, then you're under the regular tax rates that are in the front flap of the book, changed by the TCJA 2017 to run from 0 to 37%, right? Or not 0, 10 to 37%, 10 to 37. The capital gains are 0, 15, and 20 usually, long-term capital gains. Now, how about this category of 1231 assets? Because that's what's in Chapter 14, right? 1231 defined by the code. A lot of people call this just business property, right? The code says depreciable personalty used in the trade or business. That would be a machine, right, that you use to make your inventory, or realty used in the trade or business. Now that can be the building or the land under it. Doesn't say depreciable there. 1231 can be the best of both worlds. Capital gain, and it has to be long-term to be in 1231, so you're going to get the favorable rates, right? Ordinary loss. Now, why is that better? Well, ordinary losses are easier to deduct, which you might remember from way back at the beginning of the course, and we'll talk about it again some in Chapter 14. Capital losses, right, go to the Schedule D like dog. They're combined against capital gains. If you end up with a net capital loss and you're an individual, you can only take $3,000 on the front page against other income, right? The corporations with their net capital losses, they can only net them against capital gains, so they have to carry back 3 or forward 5, either using an amended return to go back or carrying forward on new returns to look for capital gains to combine those capital losses against a net capital loss. The corporations, C corps, the regular corps, they have a D, Schedule D, just like the individuals do. So the important thing here for our purposes, as it says on this slide for Chapter 14, is that 1231 is a unique asset, right? Not a capital asset, can be better. A capital gain, usually, again, we have to say usually, ordinary loss. Now, after this, when we did this at the beginning of the course, I said, okay, we're going to leave this until we get to Chapter 14, and now we're there, right? In Chapter 14, we have something that is called recapture, right? That turns what you thought was going to be capital gain under 1231 into ordinary income. And we're going to see if it's 1245 property, which is basically personal T, that the gain becomes ordinary income to the extent of the depreciation. We'll just talk the rules here, and then I'll show you that property transactions chart we just saw in Blackboard, and that should help with some numbers. So again, 1245 recapture, just get the rule down for now. It turns the gain into ordinary income to the extent of that depreciation taken. All right, 1250 recapture. Now this is basically real estate, but here we only recapture the excess over straight line, which means you have to be using accelerated depreciation. To the extent that the accelerated depreciation was faster than straight line, that's what can be recaptured. Now, if you remember back from chapter 8, the depreciation since 86 Tax Reform Act, effective 87, that's why we have 81 to 86 up there. Effective 87, Reagan's big Tax Reform Act of 86, the depreciation on real estate became straight line. There was no faster than straight line. There was no excess over straight line. So all these buildings placed in service 87 forward, basically they do not have recapture under 1250, okay? Because they don't have any depreciation faster than straight line. Those buildings are depreciated at 39 years if they're a commercial building, and if they're a rental building, 27 and a half. The commercial originally was 31 and a half, later changed to 39. Long-term capital gains rates, some of this is older here, right? Basically today, those long-term capital gains rates are 0, 15, and 20. So this needs to be updated to say 20%. But this slide is trying to tell you that the rates are applied in layers, right? And there are some special rates of 25% on certain real estate, 28% on collectibles, like a stamp collection, a baseball collection. We did the collectibles rate back in chapter 3 at the beginning of the course. We will talk about the 25% rate in this chapter 14, although I usually don't put it on the exam. This slide and then the book tries to tell you the order in which these layers apply, right? So if there is a 25 or 28% rate, it applies first. But remember, the long-term capital gains rate is supposed to be favorable. So if a taxpayer is only in a 15% regular tax rate or a 12% regular tax rate, the taxpayer pays that rather than a higher rate. Now, 0, 15, and 20, the 0 is supposed to be for, under the new rates, the 10 and 12% brackets. But you'll see in chapter 14, I think it's on page 24, there's a little gap in the 2018 law where people who are in the 12% bracket aren't still in 0. So for $100 or $200, I think it's 200 if married filing jointly and 100 for everybody else, their long-term capital gains rates are actually taxed at 12% in the 12% bracket for that last $100 or $200. That's a glitch in the law for 2018 that they didn't bother to correct. All right, now I want to get out of this. This is my old PowerPoint, right? And go over to what I showed you also in this additional resources, and I'm keeping an eye on the clock, right? We've been recording about 20 minutes already. This lecture usually takes about 30 minutes or give or take. All right, and I wanted to pull out of the additional resources here in Blackboard this property transactions chart. All right, and get this figure here.